Robert Sockin is with us now, global economist at Citi. Robert, good to have you with us here. Thank you very much. I mean, you guys were at Citi, in a way, the last sort of holdouts as far as, the Fed hike trajectory is concerned. I mean, you were more hawkish than others. Does last night's commentary and the decision and everything, I mean, the Q&A, the press conference, etc., change that now, Robert? What's your sense?
Great question. Thanks so much for having me. And you're right, going back several weeks and for much of this cycle, we've been on the more hawkish side of the street, looking for the Fed to be much more aggressive than most were. And that had played out pretty well throughout the cycle. But a few weeks ago, given all the Fed speak that we were hearing, it seemed pretty clear to us that this was a Fed that wanted to be done hiking. And so we had changed our call a few weeks back to no more rate hikes in this cycle, because you heard from Chair Powell and other members before the blackout period that they looked at the rise in long-term yields as substituting for rate hikes, and that they were inclined not to hike further. And I think what you saw at this meeting really played into that this is a Fed that really wants to be done hiking, really wants to move into a wait and see mode, and see how the data evolve from here. And so they kept optionality. They didn't take future hiking off the table completely. But Chair Powell went at great lengths to avoid saying that they would try hiking again in the future. He downplayed the last Fed's projections, which showed future rate hikes. And he emphasized, again, that long rate, the long end was doing some of the work for them, and that maybe the potential growth side of the economy has improved, and that would let inflation start to come down more on its own. So there were a lot of dovish elements within his communication, and I think push comes to shove, this is a Fed showing you that they're in no rush to start cutting rates, but they also really have set a pretty high bar for hiking again.
All right. Hi, Robert. Good morning. Good to hear, that I recall the last time we chatted, we were talking about higher for longer. Now it appears high for longer. It won't go higher from here. So hopefully that's the way it plays out. How do you approach India, though, from here on? If the Fed is going to be, holding on, Indian growth prospects are looking quite good, but we have a big election as well that's coming up. So within the emerging markets, where does India stand, versus, say, LATAM versus the Chinese as well?
Yeah, this is a great question. And within our forecasts, we actually have a fairly bearish global outlook for next year. Even though this year has come in much better than expected, we are expecting a slowdown to start next year, and for the global economy to move well below trend for the first 3 quarters next year. And that's mostly driven by softness in developed markets. So we still expect a US recession at some point in the middle of next year. We expect the Euro area to be in recession for the part of that period, the UK. Emerging markets, on the other hand, are relative bright spots within our forecast. Growth should still continue to be positive in most major EM economies. India should continue to perform quite well. And in fact, and I think we've talked a lot about this on the program, if you look at this cycle, a lot of the best performing economies have been economies in Asia, India included. And I think that's very much the contours of our forecast going into next year. So we think it's going to be a tough year overall for the global economy, but most of that softness is going to be in sort of the big developed markets. And we think emerging markets are going to continue to show the resilience that they've shown throughout the cycle.
Well, in that case, Robert, the Fed would be cognizant of the softness that ensues, right? And that is ahead. So in that case, is there a case that the Fed may start cutting rates earlier than one anticipated? What would be the data points that you'll be tracking for that? And were that to happen, what would then play out in the investment world? Would people start backing the developed markets because now their global central banks are supportive? Or will they still back the risky assets like emerging markets?
This is a great question. And first, on the outlook for the Fed, and as I mentioned, I think what you're seeing is a Fed that does not want to hike more and will go to the best of their ability to avoid hiking further, but also a Fed that has emphasized that there are no rush in cutting, and you're not even contemplating cuts at this stage. And you heard that from Chair Powell pretty explicitly today. Within our forecast, we have a recession starting in the middle of next year, and that opens the door for the Fed to be able to start cutting rates. So in some sense, in our view, our rate cuts are predicated on that recession starting, that recession loosening labor markets, and that recession bringing inflation closer to target and allowing the Fed to start cutting. But what we've seen in the US has been striking resilience, even in the face of all of these rate hikes. And we've had to push that recession call out several times. So if you go back to last year, we thought the US would be in recession now. And now, as I said, we pushed it out several times into the middle of next year. And I think the balance of risks, given the data we're seeing in the US, is that we continue to push out that recession call. And potentially we may even see a soft landing. That's not our base case, but I think it's in the cards. And in that world, I think that means the Fed's going to stay higher for longer. And that means that those rate cuts keep getting pushed out even further. And so what that means ultimately for asset markets depends on how all of that evolves. In that type of environment, yes, the Fed's staying higher for longer, but the U.S. economy is also being quite resilient. So I think it could be a positive development for risk assets in the U.S. And alternately for those emerging markets, as I mentioned, we think they're going to hold up relatively well in this environment. So I think there's scope, depending if the U.S. is able to generate, especially if the U.S. is able to generate a soft landing, there's a scope for a lot of risky assets globally to perform well.
All right, Robert, great speaking with you. Thank you very much for your time. Appreciate it here, as always, on CNBC-TV18. It's a pretty positive environment, at least this morning. And let's just hope that over the next many weeks, the one thing we can expect for sure is other Fed members to come in and weigh. As Ed Yardeni once said, I think he called the FOMC, of course, jokingly, as the Federal Open Mouth Committee. I mean, people like to talk, right? So they usually come in and try and push back against what they've already done, and the market then gets into a bit of a tizzy, etc. So I hope that's not the case, and it's a more cleaner kind of environment from here. We'll take a very quick commercial break here. We'll